All right, guys, welcome back for another video. In today's video, I want to cover the topic of continuation moves. This one might seem straightforward, but I think it's important to cover just to distinguish between simple continuation and other moves that you may anticipate being forming in the chart, but it's really just continuation. So right here we see a little bit of a consolidative move right here, or a consolidative price action, and then you see volatility pick up, and then essentially you just see continuation in the direction of that volatility. So essentially you have this range here, right, marked off by these levels here, and lows essentially right here. You can move that down to these lows here. And this is a continuation move, right? So you get the volatility spike, price consolidates, move into a low liquidity state, and then resumes volatility in line with the original spike, comes up, fills the price extension, enters another low liquidity state, and then volatility resumes in the direction of the initial spike, continuation, and then ultimately, price kind of turns around and flattens out a little bit. And this kind of ties into my personal theory about continuation, or different, kind of the rule of three. And the rule of three I use to apply to all sorts of different avenues of my trading methodology. So I'll use it in continuation. I'll look for three drives of continuation. It ties into when I'm using the RSI, I look for three drives of divergence on the RSI. Also, in my risk management strategy, I look for, if I take three losses in a row, maybe that'll kick in a different level of risk management. Maybe you're a baseball player, maybe you are familiar with baseball, and you have the three strikes you're out rule in baseball. There's something to the number three, and I tend to apply it in different areas of my trading methodology. So you have the continuation there. Let's go see if we can find different areas. Yeah, so here as well, you've got the initial spike here. So you've got this consolidation, this volatility spike, and then you get your one spike there, another drive lower, and then you actually don't get another leg down, but you get a drive below these lows right here. And then ultimately runs up above these highs and then moves higher. But this is a good example of that the being practical in the amount of drives of continuation you expect on the market helps you to avoid greed, right? So if the market gives you three drives, that's pretty damn good. Also, especially if you're actively managing within there and compounding your equity, that's great as well. And understanding that philosophy will also help you understand where the liquidity bases are forming, because you'll start to see the areas of the market where the consolidations are occurring and volatility is contracting, leading to those multiple drives of continuation. Let's see. Try to find another example. Okay, so you get a consolidation move here, price reverses, comes down, retraces there, and then essentially after here is where you get your continuation. So I'd be looking at this as one drive. Again, I know there's multiple drives within this swing, but I'm just pointing to the big obvious ones. Then you got continuation there, price come, and this is a little bit more dynamic, right? This would be more dynamic on a lower time frame. But again, you get this drive, then another drive, and ultimately you get your retracement lower. Same deal here. Got this level here. One drive, two drive, three drives. Whether you're looking at this one or this one. Again, it's not it's not always perfect, but this is just a frame of reference that I use to look at the market. So here's a good example here. This is back from January of 2021. So you had this is like a brief downtrend during the parabolic move, and you get this downtrend, and then you get this movement here, which actually I was trading this. I remember this was when Tesla announced their purchases. They actually made their purchases around this level here before this run up. So they made them back here, but they announced them right here. Of course, when that announcement hit the market, it shifted that brief downtrend, and now you get continuation. Again, there's smaller swings on the low time frames, but really this is the move. You want to mark off these highs right here. One drive continuation, retrace. Second drive a continuation, retrace. Then you get your third drive, retrace into there, and then it cools off a little bit. Again, you could have stepped away from the market after this point, and this is basically the market cools off here, even though it's still accumulating, still looking to push higher. It doesn't push higher for another week, really. So you got your move here. Maybe you take profit, maybe you step away from the market, come back later, and the market's still giving you opportunities to re-enter a long position. Again, just tying back to the original idea that greed is never going to facilitate profits in the market, so you want to avoid it at all costs. But again, you guys get the idea. I know it's a little bit of a simplistic video, but I just thought I'd upload a video on that. It's also important to distinguish, continuation from other price distinctions. So when you see continuation, you to distinguish it between like a reversal or an apex liquidity run or something like that, in a continuation move, you see a very clear sustained movement above the highs, right? So when price runs up above the highs, it doesn't retrace lower and back into the range, right? It continues up higher. Now it may retrace lower afterwards, but that initial push, it closes above, holds above, and runs up. There's your continuation. Anyway, I hope you guys like this video. If you like this type of content, just make sure to like the video and subscribe to the channel. And I'll catch you guys in the next one.